My name's Jae Oh. Thank you very much for joining. For newcomers here, I'm the author of Maximize Your Medicare. I'm also, you know, part of a think tank called the Alliance for Lifetime Income. You can see protectedincome.org. I call myself, the water boy of the think tank because we got like very highly qualified colleagues of mine here on inside the think tank, and so that's just I guess my lot in life. MaximizeYourMedicare.com is the official website for the book. It's here. The website is newly designed. You can see it here. Got new updated design. We'll get into some other features of what's inside of the website, later. Today, two topics. First topic is going to be about financial market stability to start out the year. The second is the Medicare mess is all I could really call it, because Medicare is in the headlines, politicians are involved, all sorts of, and then of course you add the media on top and you get a huge amount of crossfire. We're going to try to keep it down in terms of time today, 45 minutes or so at the most. I'm trying to keep it quick and sharp here. All right, so let's just talk about financial markets here. You can see it here. Up here is a graph of three different groups of assets. The gray is QQQ, which is the NASDAQ, the biggest technology companies, Microsoft, Apple, Google, Meta, Tesla, just the names that everyone knows. Strong start to the year, obviously. The blue is the S&P 500, much more muted, but still very, very positive so far for the year. 6.6% on the far right-hand column is your year-to-date return. Reality is that if you told me that your year's target in a particular year was anywhere in between here, you probably call it a year. We're there in 6 weeks. And you can ask the question why. You can certainly ask the question why. And for me, the answer is down here on the purple. As people who have subscribed to the Substack, people who have subscribed, listen to me talk on Jay's Corner. And not only that, but read through the newsletter. Here it is here. Be sure to subscribe to it, jo.substack.com. This is still a world where we have stocks for show, bonds for dough. It's not going to change from that, right? It's not going to change from that. It's principally still the case. It is simply the case so far this year. Oops, let's just change it to this one. So far this year, that what we have had is basically the numerator stable. And not only, I've misspoken, the denominator stable. This bottom part here, R, right, is interest rates. This is the price, this is the construct for the price of anything. It could be a stock, it's a bond, it's the value of your real estate rental property. Airbnb. Absolutely. Your market price is driven by this singular formula. My point here is that this purple line is reflecting the idea that the denominator has been this stable all year. And you can see its dramatic effect because if we just back up and take a look at different time frames, you'll see how damaging the bond market has been and how the increase in interest rates have altered everything. You can see it here. This is a 1-year look. And you can see now that bonds, which people presume to be stable, minus 10% in a year. And over 2 years, you can see minus 15%, far worse than the equity market. The issue is, of course, is if you go back then to this, you'll see that it has affected all risky assets, all of them. The cost, this is why, for example, used car prices, which many people, have a handle on, everyday people do understand that, you've had some astronomical used car prices. It's down. Why? Because interest rates for borrowing for used cars is now high single digits if you want to take out a loan in order to buy a used car. As a result, of course, the NPV, in other words, the price, declined. So what do you have? Used car market lower. Where I highly suspect that is nowhere close to being finished. On that specific sector, maybe the third or fourth inning, maybe. More to come. Not higher, right? Clearly. Because the same people who are borrowing are the same people who are over levered on credit card debt, etc. There's a reason that unemployment is this low. Pretty much, I think everyone got the bell. Time to get back to work. We've got bills to pay and loan interest to pay. Critical. That doesn't mean that I'm saying that all debt is bad, by the way. That would be in an entirely different segment, an entirely different video. One that's on my to-do list. Back here. Basically, what has happened here is that the interest rate market has been very stable throughout the beginning of this first 6 weeks of the year. Very stable. And so much so you can see this picture here. This is a picture that I kept. Let's just see. Let's hope that I didn't blow it away. Of course, I probably have. Yep, here it is. And here it is. So it's called MOVE, M-O-V-E, and this is bond volatility. And you can see here the lavender line here is low. That even with interest rates themselves higher, you see that the volatility, the up and down, is lower. This is a very important thing because I've stated multiple times here on Jay's Corner. When I'm talking about the denominator, here, I'm talking about two aspects. Number one is the level. Number two is the volatility, the speed, the uncertainty of that R moving up and down. Because when R is moving up and down in a violent fashion, it's hard to plan. Jay's Rib Shack doesn't know whether or not he can expand into another branch. He doesn't. Why? Because I don't know whether or not I can buy a second branch because I've got to borrow in order to finance the purchase of the second branch and expansion. When I don't know what R is, then it's hard for me to plan. Not coincidentally, by the way, deep in the weeds, far out of sight from everyday investors, is the idea that this is a concern of Jay's Rib Shack and every other company. It is not a surprise to me at all that with this amount of stability, be as you reflected in this purple. Is that purple? That with this amount of stability in the interest rate market, who has borrowed? Companies. Companies have gone to the well in record size. Why? Because they need to plan. The absolute level, if they think that they can make money and beat their cost of borrowing, they borrow. Right? I didn't say that all debt is bad. Volatile borrowing for everyday people is bad, and for companies. So as a result, what have they done? They've taken the stability and borrowed. Used the opportunity of that stability to borrow in size, in massive size. There's your market so far for the year, and basically that also then explains, on a micro level, that explains today. That absolutely does explain today. Which is, you can see it here. This is grabbing the headlines here on investing.com. And this is just where I get, generic information. I'm not gleaning anything too much other than to get information about what the narrative that exists out there is. And you can see here that, yes, Federal Reserve Bank James Bullard says the prospect reverting to larger hikes isn't off the table. What would that do? That would change the volatility. So both level and volatility higher is going to would in that instance, if it were to materialize, result in more unstable R, which means more unstable price of risky assets. That's exactly what you got today. And that's not to say that, any one day can be noise. Absolutely. Can be absolute noise. I understand that, right? And I'm not saying that, okay, well, this is going to, today's not financial advice. I have no crystal ball. But what I'm saying is that, is it surprising that the market reacted to that particular input? No, it should not be, right? Nothing has changed from yesterday to today on Microsoft implementation of ChatGPT technology in Bing, right? That didn't change. What did change is perceptions, understanding of what's going to happen here on the denominator. And since that was a key input on the year to date returns of this graph here, since that was key, and the fact that this purple line here, which is the bond, it's AGG is the ticker, which is the US dollar bond market for all borrowers, including governments and corporates. Since that has been this stable, if that's called into question, then you're going to have questions about the risky assets. Now, I have said this in the past when we've seen massive increases in risky asset prices. It hasn't changed anything. The message isn't different than what I have said in the past. Right there, it's not a coincidence here that I joined this think tank, which is centered on annuities. And the reason for it is because of the fact that this is that window with interest rates this much higher, that this spreadsheet, which is kind of what I take financial planning clients through step by step, year by year, figuring out when to accept every aspect of all of the components of your financial life. Social Security, in your portfolio strategy, approach, timing of RMD, etc., all of the different elements, tax and tax efficiency. That this is that opportunity. I do still believe that, which is that interest rates higher have provided a window for savers, for the stability. Because of the fact that interest rates are higher, these components here, and let me just increase the size here so that it's more readable for the screen. So you can see the far left column. Down here, I put this row called extra structures. I highlighted it there, and it's in green. And in there are annuity and insurance. And it's not because tomorrow you're going to deposit into these structures to learn about these structures and then become instantly wealthy. No. But they're a component now which are yielding returns to add layers of stability and layers of return. And in that same way, you can understand the way that I'm presenting this. The reason that household portfolio, the reason that pension fund portfolios are doing well so far year to date is because of the fact that there's this layer, a big part of their allocation is more stable. It then therefore allows them to take extra risk with what remains. In that same way, you're there now here. 2022 for last year, for what many people don't know, it was a record year for annuity sales. And, as usual, Jay's a very very reluctant salesperson, even though I'd be able to explain every clause in all of annuity and all of IUL, GUL, which are life insurance, retirement plans, etc. So while I can explain the language, my real focus here for Jay's Corner and for other people, our clients here, is to, we can get to the nitty gritty, but this is your first step. What role could it possibly play based on where you're trying to go, what you're trying to accomplish, when, right? Your goals, etc., are different at 62 versus 55, right? Now our looks are different. And I'm going to say that my generation, middle-aged generation here, this is that window for me, which is the combination. It is a possible path for the generation who's going to have the most difficulty, which is my generation. I don't think that there's any question. And every passing day, I continue to have that conclusion, right? Which is that the person's thinking about retirement at some point in the future, with responsibilities to multiple generations, taking care of senior parents, children, both, and their own generation. So this is the sandwich generation. That's why why they coined that phrase. This is a particularly uncomfortable time, but a possible path out, which is because of higher interest rates. Now these green structures now have potential for returns and stability both, which did not exist as little as 2 years ago. 2 years ago, you can remember, 10-year note at 1.5%. Now you're talking about what? 3.8%. Quite a difference. Because it doesn't look like much, 2%, but what the companies are doing, the insurance carriers, the offering companies of these extra structures, they're using this money in order to enhance the return profile of all the rest of the structures. The annuity structures will look better. The insurance crediting will look notably better as a result of the fact that interest rates are higher. Although I'm diverting, this also means that those persons who are already involved in life insurance, for example, index universal life, guaranteed universal life, whole life, it's time to re-look at what you have, because of the fact that time has passed, and if you can pass underwriting, that the pricing has become more favorable to you. And you can avoid certain things if, depending on your situation, you can also access better return profiles if you qualify, if you go through health underwriting. Anyway, for financial markets then, again, we are back to then, the question then going forward here is, how long are we going to stay this stable? And you can remember I've said stocks for show, bonds for dough, because it's very closely related cousin. Very closely related cousin is foreign exchange. And what have we seen there? The same. In fact, we've seen a very cooperative market here for dollar assets. Why? Because the dollar is weaker. This blue line is the US dollar index, DXY. And you can see that from here, right, you've seen a notable weakening in the US dollar. This stability here, and if we just narrow it down then to the year to date, you see it here. And now you can also see a slight uptick now, but you don't see much movement because when you back up and you look at the year, we are back now to as all the way back to what is the middle of last year. We don't have a panic selling of foreign currencies. Now, this is important, right? This is that idea of why I said stocks for show, bonds for dough, right? There's no comparing the size of the foreign exchange market to any other market. I have said stocks for show, bonds for dough, but the reality is it's more of an illustration about the fact that the bond market dwarfs the stock market, and the foreign exchange market laughs at both. And the reason that this becomes so important for the risky asset market, right, has been explained to you in the past, right? I've explained it to you here under Jay's Corner here, where I've talked about the foreign exchange and what happens on foreign exchange, which is that to foreign investors then, U.S. assets have looked cheap. They got cheaper. So as a result, they could allocate into U.S. dollar assets at a lower price when denominated in their domestic currency, right? It didn't take me as that many euro in order to buy 100 shares of Tesla. So you can see what has happened, right? The dollar stable at a lower level. Switch your euro into Tesla. Tesla gone up from 100, basically from what? 110 to 210 this year. Explains a lot of QQQ, by the way. Between that and Meta, if you took those two elements out, and I haven't done the math, I'd be very curious to see what the rest of the returns look like. As long as these are in place, this stability, the debate is going to continue to rage, right? Earnings have been disappointing. All of the debates here around the numerator are going to continue to fester. We're going to keep having them. You're going to keep turning on CNBC. You're going to keep watching, reading the Wall Street Journal. Where are earnings? Earnings have been, squishy at best, right? We don't have any companies like telling you massive blowout in earnings other than Netflix, right? We don't really have headlines where companies are doing that great. Hasn't mattered. Why? The stability here of the bigger markets. Can this continue? There's your $64,000 question, right? I mean, in other words, I'm under the view that as long as this can stay stable, then you're going to have up and down because you're going to have ongoing debates on the numerator. But as a result of the numerator of the denominator being stable, then the debate and numeratorville is going to run the narrative, which can pressure stocks higher for longer than people have thought. And so you've got people all over the place kicking and screaming now, which is this is too far, too fast, short covering this, short covering that. And I've explained that to you on the YouTube shorts, right? Which is basically, baby tomato, mama tomato, papa tomato. Right? So Uma says, ketchup. And you'll have this dynamic because of the way that portfolios get run, mutual fund competition gets run. That's all I'm going to say at the moment for now. Do I think that this is at risk? Of course. Why? Because this purple line, right? We've presumed that the purple line, what is underlying here is the purple line is going to stay stable. And you can see it here, picture number 2 that many people have seen for, followers, right? If you have lower volatility, your number of outcomes has declined. The window, that blue curve on the right, narrows. If it narrows, then the price movement of bonds declines. If that happens, you can have blue and gray. That also means, very similarly in the spirit of this diagram, the other side of the coin exists, which is if there's something to upset the stability of this purple line, then what's going to end up happening is you're going to go, oh yeah, and by the way, all of our C1s, which are our earnings per share, they haven't been that great. And now you can unravel. Rather than giving you a hot take, we're definitely going higher. We're definitely going lower. What's more important here for everyday people, their practical use of everyday people then, for me, is the idea that you understand what you are fit and what you're facing here. That you understand what your risk you're taking. Jay has zero problem if you want to say, Jay, I want to hit a home run. Okay. If you want to swing for the fences because you need to hit a home run, well, and those are the results of your circumstance, you can deal with that. You can. If you're saying, Jay, I can't stomach the up and down at all for whatever reasons, that's different. In other words, there's a world of difference between you taking risk because you've chosen to take the risk versus you're taking risk and you didn't know what risk you were taking. Right? The first one is completely acceptable. Completely acceptable. You've got your own priorities that are none of Jay's beeswax. You've got your own ambitions, objectives. Right? Those aren't my... I don't have a vote. I don't want to vote. Right? That's your money. What I'm trying to keep you away from is the fact that you look at your statements and you go, I didn't know these were the risks that I was taking. And nobody looks at it when it's up. Right? Well, for basically the last 18 months, a very, very tough road. A very tough road. In other words, I'm looking for that stability. If it doesn't have that stability, then, and you can see it here, this is that video that I keep referring back to on Henri, and this was about the hurricane that hit during, last year. 2 years ago, 2021. Right? We saw the misgivings here because basically what I was saying was these curves relative to each other, they started to get messed up. Ultimately, that's the bottom line of what I was saying at that time, creating this video, and then 2022 occurred. Wasn't a huge surprise. The issue is now, last year, 2022, these numbers, qualified funds, IRA, depending on who you ask, the summary statistics basically tell you that, targeted retirement funds, etc., IRAs, minus 20%. For me, that would have been too much. Right? In other words, for example, the stable avoided it because we knew about this. Without being predictive, we were observing this. We are not getting paid enough in order to accept this amount of risk and what could happen. So now you can understand this is a world of difference, right? Because from 100, if you were at 80 versus at the end of 2022, right? Now you're at best, what, 88? Versus if you were at 90 at the end of 22, you're now at 94, 95. That 7 is enormous. Every single digit here is huge because you're trying to let this money stretch all the way out for however long your objectives will be. And now you can, of course, understand why this green row here, which is that any numbers in here, adding a layer of stability, allow you to accept further up and down. Why? Because Jae's sole objective, the sum. I don't care how we got there. I want us to get there to the spot that you want to go to arrive without taking risks that you didn't sign up for.